On Wednesday, both the S&P 500 and the NASDAQ saw its worst trading day since 2022. The broader S&P 500 fell by 2.31%, while the NASDAQ closed at a 3.64% loss. The two culprits behind this fall were Tesla and Alphabet, both of which post returns that were worse than analysts expected. There's no denying that red days aren't fun, especially bad days like what we just went through. But for all investors, whether you invest for dividends or share price growth, red days offer great opportunities. In the case of dividend investing, if your goal is to retire off dividends and you have money to invest while the market is down, any investments that you make can result in you retiring earlier. If a dividend stock that's currently yielding 6% falls in share price to the point where it's now offering a 7% yield, that extra money is going to make a difference. It might not seem like it's a big deal, but if you're reinvesting all of your dividends and allow it to grow over the years, then even 1% can result in many thousands of dollars later down the road. Admittingly though, it's not easy to do, as panic selling is usually your first thought when you see a red day like this. But it does get easier the longer you remain invested in the market. After so many years of investing, there really aren't too many days that surprise you. And given the recent events that just took place, I've been picking up additional shares of some of my holdings to collect an even higher dividend payment. One investment I've been buying more of is the Reeves Utility Income Fund, ticker UTG. It's a closed-end fund that invests in public equity and fixed income markets of the United States. It seeks to invest specifically in dividend-paying stocks and debt instruments of companies that are operating in the utility sector. UTG's investment objective is to provide a high level of after-tax income and total return consisting primarily of tax-advantaged dividend income and capital appreciation. According to their website, UTG pursues this objective by investing at least 80% of its total assets in dividend-paying common and preferred stocks and debt instruments of companies within the utility industry. Additionally, up to 20% of this fund may be invested in securities of companies in other industries. I realized I haven't talked about this holding in a long time, actually over a year at this point. But behind the scenes, I have been building up my position in UTG. Because it only holds utility and infrastructure related companies, it likely won't ever become a huge part of my portfolio. But there's a lot of good reasons why I do like this closed-end fund. The sector itself is known for paying higher dividends, and UTG pays monthly, which is great. Also, in its more than 20-year history, it's never gone through a dividend cut. It has been negatively impacted by high interest rates, as it hasn't seen share price growth over the past 2 years. But as I've been saying for a while at this point, once the feds do start cutting rates, then utilities and these infrastructure-heavy companies will benefit from that. They tend to borrow a lot of money to make upgrades and repairs on their assets, which are very expensive. But right now, UTG is still offering a yield of 8.1%. Another fund I picked up more shares of is the NEOS S&P 500 High Income ETF, ticker SPYI. This ETF describes itself as a fund that seeks high monthly income in a tax-efficient manner, with the potential for upside appreciation in rising markets. The fund invests directly and through derivatives in stocks of companies operating across diversified sectors and uses derivatives such as options to create its portfolio. This ETF seeks to generate high monthly income from the premiums earned from SPY call options as well as dividends received from the fund's equity holdings. As I mentioned in previous videos, SPYI continues to be my favorite high-income ETF. I also own shares of QQQI, which follows the same strategy on the NASDAQ, but I do hold fewer shares of that ETF despite its better yield because it's a riskier index that holds fewer companies and it's largely tech-focused. I've continued to be pleased with SPYI and its performance up to this point. It's well diversified since it invests in the S&P 500 index. This ETF utilizes a call option strategy that can include both sold and purchased SPX index options, which can provide the opportunity for better upside capture in rising equity markets compared to other CC funds that exist. It's also actively managed, but it doesn't come with a sky-high expense ratio. Because it's actively managed, it seeks to take advantage of any tax loss harvesting opportunities. The fund managers try to save its investors money on taxes by doing this and utilizing 1256 contracts. It's purely an income holding though, so I wouldn't expect a great deal of share price growth to come with this ETF. The vast majority of the returns will likely come from the dividend distributions themselves. So if you're fine with that, then this ETF might be worth it for you. Another holding I've recently bought more shares of is Vici Properties, ticker VICI. Vici is an experiential REIT that owns one of the largest portfolios of market-leading gaming, hospitality, and entertainment destinations. This company is most known for their real estate on the Las Vegas Strip. This REIT owns some of the most popular hotels and casinos in Vegas, including the Venetian Resort, Caesars Palace, and the Mandalay Bay. In addition, they own 2 convention centers in Vegas, as well as 26 acres of undeveloped land, which they intend to use at some point in the future. Aside from their Vegas assets, Vici also owns several properties in Atlantic City and throughout the US and Canada. As I like to highlight with this company, they have a lot of really tremendous things about them that separate them from other experiential REITs and most other REITs out there. Because normally I wouldn't like to invest in a company like this. Experiential REITs are very cyclical, much like hotel and office REITs. They can be good holdings during good times, but during recessions, they often slash their dividends. This has been the case for another high-profile REIT in this sector, which is EPR Properties. During hard economic downturns, they've had no choice but to slash or temporarily eliminate their dividend. And since I don't usually like to hold cyclical investments, I normally stay away from them. But Vici is truly in a league of their own. While most REITs have an average lease term of 8 to 14 years on average for their tenants, Vici has an average tenant locked in for 42 years. Not only that, but because they own so many properties in a prime location, they're able to raise rent at a rate more than 4 times faster than the average REIT. As of last quarter, their dividend payout ratio was just 73.6%, which is better than many other REITs right now, including Realty Income and Triple N. Their dividend growth rate is also much better than average. According to Seeking Alpha's information, they have a 5-year dividend growth rate of 7.62%. And also for an equity REIT, its yield is currently higher than average at 5.49%. One more holding I've recently bought a little more of is PTY, which is the PIMCO Corporate and Income Opportunity Fund. It's a closed-end mutual fund that invests in fixed income markets around the world. PTY invests in corporate debt obligations that are rated Baa or BBB rated and in the highest non-investment grade categories. This fund focuses on intermediate maturity bonds across multiple industries and sectors, including technology, healthcare, and financial companies. PTY is one of my favorite PIMCO funds, and in my opinion, it's quite a bit safer to the alternative PDI. Just like with utilities, the fixed assets in PTY should see a recovery when interest rates start going down. It pays monthly dividends, and it has a history of occasionally changing it. For example, it was paying 12 cents back in 2009, then they grew it to about 14 cents a few years later, and now it's roughly at 12 cents again. This fund mostly holds corporate debt, but it also holds emerging market debt, commercial MBSs, and municipals. The scariest thing inside of it, if you could tell from its description, is that it holds non-investment grade debt. This debt does come with a higher yield, but there's a greater chance of default. Fortunately, PTY does have a great track record when it comes to picking good investments for it. It made it through the worst financial crisis since the Great Depression, and it only had to temporarily reduce their dividend. But with that being said, that's just some of what I've been buying recently. Let me know your thoughts in the comments below and if you've been buying anything in the past few days. Alright, thanks so much for watching today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.